Hello, guys. This week we're going to talk about optimal capital structure. So basically, the question that we're trying to answer here is that previously we say that there's a Miller-Moghini theorem saying that the capital structure, so under perfect capital markets, right? If there's no tax, no transaction cost, and perfect competition, then the capital structure doesn't matter for the value of the firm. All right, so that is how much you borrow. It doesn't matter for the firm value. So it does not change the. The debt ratio basically is independent of the firm value. This is what we talked about last week. This week we're gonna relax the assumption of the Miller-Moghini theorem a little bit. We're gonna assume that there is a role for the tax, right? Then we're gonna see what are the implications of having the tax in the picture. So that's gonna change things a bit because first of all, if you have higher debt, right, and we consider tax, then the basic intuition here is that if you have higher leverage, higher debt ratio, you're gonna have a lower pre-tax income, meaning that you will have to pay a lower tax, right? So this is one of the benefits of having higher leverage when we consider tax. And we're gonna explore this particular point. And then after that, we're gonna talk about what is the optimal capital structure, right? To balance the two competing forces. One is that if you have higher leverage, you're gonna enjoy the tax benefits, right? But on the other hand, you also have to suffer from higher default likelihood, right? That is the downside. So then the question is, because there are two competing forces, what is the optimal capital structure, right? And we're also going to talk about what is the downside of having too high leverage, right? So, there are two parts of this cost. One of the cost is indirect cost, which is you might not necessarily go bankrupt, but it might affect shareholders' incentives to invest. Right? So this is indirect cost. Second, there are direct cost. Right? Direct cost is when you actually go bankrupt, when you actually go default, then you have to involve those uh, cost of filing bankruptcy filing, the cost of the cost of settling the company, right? Basically the cost of going through the bankruptcy process. So this is what we are going to talk about in this topic. And first of all, we're gonna introduce, like we said, we're gonna introduce market friction. All right, and and the particular market friction we're gonna pay attention to here is tax policy. Yeah. So the motivation for why we want to introduce this particular market friction into the picture is that we believe the original Miller-Moghini theorem is true, right? Meaning that the debt policy is totally irrelevant. Then what we should see is that the actual debt ratio should vary randomly from firm to firm and industry to industry, right? Because it doesn't matter for the firm value. So then as a financial manager, you should basically randomize between having high debt ratio or having low debt ratio, right? This is the implication. But what you actually observe in the reality is that in some industry, companies borrow much heavily than in others, right? For example, hotels and airlines, they are huge issuers of debt, right? So they have a higher leverage ratio than other industry. Second, high-tech businesses finance almost entirely with equity, right? And also, growth companies rarely use much debt despite rapid expansion and often heavy requirements for capital. Now you can see there's a clear distinction in terms of leverage ratio across industry. As an industry, they have very high leverage ratio. Some industry, they have low leverage ratio or debt ratio. Yeah? So this is the kind of contradiction that we observe in the reality if we think about the Miller-Modigliani theorem saying that the debt policy does not matter. Now, there are a couple of things that are not considered in the Miller-Modigliani theorem. In abbreviation, we're gonna call it MM. Right? So first of all, taxation, right? So for example, corporate tax and personal tax, these things are not considered in the Miller-Modigliani. And second, cost of bankruptcy, right? This is also not considered in the Miller-Modigliani. Right? For example, if you have a higher debt ratio, your bankruptcy cost might be higher, right? And also financial distress, right? When your debt ratio is higher, the likelihood of experiencing a financial distress is high. Right? And basically, different financial transactions, they are taxed differently. Right? Interest payments, they are tax exempt for the firm, right? Because again, when the firm decides to pay tax, it's based on pre-tax income. Yeah? Second, dividends and retained earnings, they are not exempt from tax, right? You need to pay, if you're a shareholder, you have to pay tax on your dividend income, right? And also for firms, they also need to pay tax on retained earnings, right? So here the difference is that for the shareholder, if they receive dividend, you need to pay personal income tax, right? Because this is part of your income. Then for companies, they need to pay corporate tax on the retained earnings, right? These are two different kinds of tax. And now here the financial policy actually matters, right? Because it potentially affects the firm's tax bill. That's why it matters. And now we're gonna formally quantify what are the benefits of having a higher debt ratio, right? If we have tax in the picture, right? Meaning that if firms have to pay tax, right? Now, the first thing we're going to learn from this is that tax shields can be valuable assets. And what are the tax shields? Tax shields are basically the potential tax savings from having a higher debt ratio, right? Again, this tax shield is coming from the fact that if you have a high debt ratio, you're going to have a lower pre-tax income, right? Hence lower tax. Right? This is the tax shields, right? And the tax shields depend only on the corporate tax rate and the ability of the firm to earn enough to cover interest payments, right? And we're gonna use the expected rate of return demanded by investors to discount it. So why do we want to discount it? Because we assume that there are multiple periods, and each period the firm is going to pay tax, and also the firm is going to pay interest on the debt. So, and then what is the present value of the tax shield? It's gonna be the tax savings the firm has for each period and divided by the discount rate, right? So what are the tax savings each period firm has, right? That is the corporate tax rate times the interest payments, right? Because remember, this interest payments is potentially the reduction in the pre-tax income for the company, right? Remember, this is the reduction in the pre-tax income for the company. Now, if you times the corporate tax rate, then the numerator here, it's gonna be the tax savings, right? Basically, the tax deduction firm are able to achieve when they have a higher debt ratio, right? and then this happens for each period. Right? So now let's look at one concrete example. Right? In this example, these two firms, the unlevered firm and levered firm, all right, their earnings before interest tax, they are the same, right? But the difference is the levered firm, each period they have interest payments of $80, right? And we assume that the tax rate is 35%, all right? Now, in our case, you can see the pre-tax income is already lower for the levered firm, right? So what is the consequence? The consequence is that the net income for the shareholder, it's going to be different, right? It's going to be lower for the levered firm, right? Now, and then if we look at the total income here for the unlevered firm is going to be 650, right? And the total income for the levered firm, for bondholders and the stockholder, it's going to be 678, right? So this is basically the total income to both bondholders and stockholders. Right now, you can see, obviously, you can see the total income to both bondholders and stockholders are higher in the levered firm. Right now, you can see we now already have a conclusion here, right? Or have a conjecture here. That is if you have a high debt ratio, the firm value is high. Right? Because you can see this total income to bondholders and shareholders, this is already a proxy for the firm value. Right? Now then we can calculate the interest tax shields every period, right? And it's gonna be 0.35. This is the tax rate times the interest payment every period, all right? So for this levered firm, it's gonna be 80 times 0.35, right? So this is the interest tax shields every period. Right? So that is the conclusion here is that the debt financing has one important advantage. That is the interest that the company pays as a tax deductible expense. Right? So here we already see interest tax shields, right? So levered firm tax bill is $28 less than unlevered firms. Right? Now suppose the debt is permanent, right? Then we assume the expected return